Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
There's no real reason to be worried about a recession. There is some slowing in the picture. But the other thing is that part of the reason we're getting slowing is high inflation. And I think the combination of high inflation and tight labor markets is starting to change the inflation process, which over time is not good for the sustainability of this expansion.
What did someone say to us yesterday? The hurricane at JP Morgan downgraded to a light summer breeze. Bruce Kasman there over at JP Morgan. Saying something different to what we heard from the CEO. last week, which is fine because one runs a company and the other guy is running research. Equity futures down 0.8% on the S&P 500. On the Nasdaq, we're down around about 1%. Are we in for a slowdown, maybe even a recession? It depends who you ask and what stock you look at. Target cutting its profit outlook for the second time in 3 weeks. That stock is down 9%, Tom. You ask a retailer, there's a struggle, clearly. But if you ask an airline right now, Tom, how the consumer is, they'll give you a very different answer.
They will. I mean, that's right now. I'm watching prices, John, in New York to LAX has just started to creep down a little bit. I'm watching that every day.
And the plane's still full, Tom. It's still full.
Yeah, but it's out there. And Cabana said in his note, there's every shop has a different view on this coming slowdown. We'll have to see as well. We're watching Target here this morning with some good perspective coming on radio and television through the morning. Right now, and this is a joy, John and Lisa are going to talk to Vincent Reinhart of Dreyfus and Mellon, their chief economist, about the moment at hand. He's a little concerned about communication at the Fed, but I want to talk about the communication at the beginning of the panic. Reinhart and Reinhart, Carmen Reinhart, your wife who's at the World Bank, wrote the mother of all essays of this pandemic on the pandemic depression. And we are now, Vincent, at a point where, as you said then, the global economy will never be the same. If I may, can you expand on that and tell us how this global economy will never be the same as we are now somewhat out of this pandemic?
Well, let me first admit where we were wrong. Back then, we were worried that there would be a long, dramatic, and persistent decline in output, and that was because there'd be insufficient policy stimulus.
And policy showed up.
Worrying about policy stimulus was not that relevant, and that's the really good news. But what's the other key message? That is economic dislocations, whether it's a recession or just depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people. People act differently coming out of severe economic dislocations.
So let's go to Lawrence Summers and Olivier Blanchard and talk about hysteresis, which is when you're out of the system, you never get back. Are we so much out of the system that you have to mark down GDP and the Fed maybe will be more dovish because they will have to mark down due to our pandemic hysteresis?
Well, a big lesson. And by the way, Tom, what is the most costly thing coming out of a recession or a depression? It's the lessons you take away from it, because that influences how you think about behaviors for the next couple decades. So we're all
depression babies like our parents.
Exactly.
Is that what's going on? Lisa, you're too young for this, but Reinhart and I grew up as depression. We had parents who were depression babies. It was terrible.
So that's really exactly where I wanted to go. When do we start to see consumers pull back, especially given the fact that it seems like Target and perhaps others are not able to pass along the price increases as rapidly as they'd like?
Another message of the paper Tom was talking about is the shock was very regressive in incidence, i.e. it really hit low-income families harder. So when you talk about the consumer, you got to ask who's got the wherewithal to withstand a slow patch in the economy. Remember, probably there's still about $2 trillion of excess savings socked away, given all the government programs in 2021. Those households will be able to ride out the shock. However, lower income households are going to have a harder time, and we are going to see some pulling back. But what's the key metric right now that tells you households aren't really that worried about recession? Saving rate is low. If people were worried about their income prospects, they wouldn't be spending so much out of their income.
Which might be a good thing and might be a bad thing, especially because the quits rate is going up too. So it's not exactly as though people are particularly concerned, but maybe they should be, is what some people are saying, especially as they forecast the potential for recession out in 2024. When do gas prices become recessionary? When do oil prices higher actually become disinflationary rather than inflationary, as some people are projecting?
So I think the person asked is Jim Hamilton of UCSD, who's done the important work on oil prices and economic business cycle. And the plain fact is, when oil prices move away from where they've been for a while, when they get salient in household decisions, when they really get your attention, that's when they matter for economic activity. And guess what? We're long past that point. Yeah. It is number one concern among households. It's got to be crimping household spending, particularly for those who get hit harder, lower income households.
Vincent Reinhardt, Jerome Powell is not going to show up, as you, I'm sure, Coach Alan Greenspan, to Humphrey Hawkins or whatever it's called now, and say, frankly, I don't give a damn. But it is a gone with the wind market. You say Scarlett O'Hara is sitting at the Fed table where tomorrow is another day. Is it a day with too much communication? Is this a Fed talking way too much versus a silence in the halls when you were there for 24 years?
Well, I'm going to date myself, but I will admit one of the formative books coming into the Fed, which was the big book of the late 80s, was William Greider's Secrets of the Temple. That talks so much about
Are they talking too much now? Lisa gets up and does our brief here. John, we're in a quiet period, right?
We are. No Fed speak, Tom. That's
no
Fed
news. Speak. Do you want that? Do you want a permanent quiet period?
No.
Except for Chairman Powell?
No. You got to listen to the chair. There are opportunities for members to talk. Part of the genius, if it is a genius, of the construction of the Federal Reserve System is to let a diversity of opinions flourish. And if there's a diversity of opinions, you want to hear that. However, it's not helpful when everyone's talking and everyone's reading the same page of the hymnal. How much information did you get from Fed speakers over this intermeeting period? What they told you was the summary of what would appear in the minutes, and that Chair Powell already told us in the press conference. What I worry about is their communication strategy is fractured. Gradualism, what they're doing right now, we're going to do 50, we'll do 50 for the next couple meetings, is about very near-term guidance because tomorrow's another day. Listen to Chair Powell at the press conference. He doesn't want to talk about hypotheticals and doing things in the future. But then they publish the summary of economic projections that gives a sense of where interest rates are going to be 5 years from now. It's not consistent.
I'm afraid to ask this. Let's go with it, Vince. John, have you seen Gone with the Wind?
I haven't, Tom. Not really my style, those kind of movies.
You know,
we're out of time, too.
By the way, you're exactly right. It's not politically correct.
Can you see
anymore.
Lau Brainard turn to Chairman Powell and go, "Sir, you are no gentleman"?
No. Vincent Reinhardt, thank you. Tom, you've got to keep an eye on the clock. You're out of time. Vince knows more about the clock than you do, apparently, which is why he stopped talking.
Gone with the Wind.
Futures down 0.8%. From New York City this morning. Good morning. This is Bloomberg.
the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu ramai sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
While the recession risks have gone up, the U.S. recession is still not our base case.
I think you'd have to get hit by much bigger shocks to really talk about recession anytime in the next 12 months or so.
It's really financial conditions that affect the economy.
I'm not sure we've seen the high yields. We may go back and test those. The fundamental assumption behind all of our modeling is the idea that we're going to see a material slowdown in economic growth but skirt the recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, on a most eventful day. John, we're supposed to get to CPI Friday, but on the way to it, we've got to look at corporations adapting and adjusting. Target adapts again.
One stock, Target, down 8.7%. One fear that it's more than just Target. That's the problem right now. People are spooked by this, Tom. You see it from Target, from Walmart, from others as well. Margin pressure. Is it just the retailers, or will others follow?
Well, it can be the others follow, but let's say they clear out their problems right now. Let's be optimistic about that. John, it's to me the then what of, say, autumn and into 2023.
So, Tom, in their forecast, they are optimistic. They see the pain in Q2. They think things get better as the year grows older. The problem is, for a lot of people in this market, they've been conditioned by the last 3 weeks. This is the second time in 3 weeks that Target has done this. And Tom, if they've been wrong about the last month, are they right about the second half?
The Fed sees us, Vincent Reinhardt, just talking about a naturally dovish tilt, or rather it was Mark Cabana, Mark Cabana talking about a dovish tilt. John, does the ECB have a dovish tilt the way interest rates are moving in Europe?
I think, Tom, to be fair, I think both the ECB and the Federal Reserve still has a dovish tilt. And this is why. Don't listen to them. Just look at where rates are relative to where inflation is. That's pretty dovish. And if you landed from Mars back on Earth and looked around at where inflation was and where the policy rate was, Tom, you would say that these central banks were still very dovish.
At least it's a gallon of gas higher.
And frankly, what does this do to the corporate profits? This is really what's feeding also into Target. But also, at what point does this crimp consumer demand? At what point are we looking at the rate hiking fears of the first half of the year translating into profit fears, into a consumer with less resilience? And that, I think, still remains an outstanding question.
John, Jason Furman writing brilliantly in the Wall Street Journal today on a compare and contrast. Wage growth in the United States up 6%, in the EU up only 3%. John, I don't buy it. The Fed and the ECB have the same problem, given what we see from Target or the Target of Germany.
They don't have the same problem. The labour market here is stronger than the labour market there. The other thing I'd point out, Tom, don't compare headline inflation in both regions either. Look at core inflation. Core inflation in Europe is much lower than core inflation in the United States. In the United States, we have a much broader problem with price pressures.
We're going to see that on Friday. You need to stay with us today and on through Friday to see about the inflation opinions of our good guests on the equity market here in a moment. John, I don't even know where to begin on the data. Why don't I begin with Target down 9%?
And equity's down too. On the S&P, on the Nasdaq, we're down 0.8% on the S&P 500. On the Nasdaq 100, we're down a little more than 1%. Yields higher. The story of the last week. The story of last week, up 20 basis points. The story of yesterday, up 10 or 11 this morning. Down about a basis point to 3.027%. And in the commodity market, crude, negative 0.2%, 118. And just some big forecast coming out of the team over at Goldman, Tom. Looking for 140 on Brent in the third quarter, looking for 137 on WTI in just a few months' time.
John, maybe you know more about this than I did. Did Ed Morse capitulate yesterday?
A little bit.
Yes,
a little bit. I wouldn't call it capitulation.
Okay, thank you.
Maybe marking to market a little bit, Tom. Just a bit.
Oh, okay. I don't know where that goes. I'm looking at yen, folks. For those of you on Global Wall Street, I'm sorry. This is a more sooner story than what I'm hearing from our guests. A 132, almost 133 yen is an immovable force for the mechanics of the Pacific Rim. Right now, an immovable force in the equity market. Sam Stovall joins us, Chief Investment Strategist at CFRA. Sam, what is your tone of your mid-year review?
Well, good morning, Tom. I think the tone is one of confusion, as you can hear just by your conversations with Jonathan, et cetera. From an economic perspective, our forecasts are that we are not going to be falling into recession anytime soon, but history tends to disagree. Whenever the last 5 times since World War II that we have seen headline CPI rise above 6.5%, which is one standard deviation from the mean, we have always fallen into recession and been accompanied by a bear market.
Sam, this is the expertise of CFRA and all that you do with your STAR system, which is what corporate officers do when they're handed a slowdown, margin compression, maybe even the gloom of a recession. Don't they act faster than what we expect?
Well, the management does tend to act pretty quickly. I mean, just take a look at what the guidance has been from companies to analysts. Just looking at second quarter earnings revisions today as compared with where we were on March 31st, basically you're seeing consumer discretionary having second quarter revisions downward by more than 16%. And in a sense, you know, what you're finding is these companies are very quick to get out there to say what the problems are likely to be, to let the stock price then reflect those revised numbers so that when the reports do come in, this will probably end up being a quarter in which the actuals come in a slight bit better than forecast, as we have seen in the 51 of the last 52 quarters.
Wait, this is important, Sam. You think that what the companies are telling us accurately reflects the scope of the pain and perhaps gives a floor to some of these valuations that possibly could lead to buying opportunities?
I think that by assuming that a floor is being put into place, I think is a bit premature. I think that what these companies are doing is acknowledging that there is weakness ahead and that you have some companies that are saying, you know what, we're not even going to offer guidance because we just don't know. So I think that what is happening is that you are continuing to see that floor be revised downward, but I don't think that ends up being a very solid floor.
So Morgan Stanley's Mike Wilson actually pointed to this as one of the reasons for more of a sell-off and a potential 3,400 target on the S&P later this year, because when those second quarter earnings revisions come out downward, people will reset. Do you disagree?
No, I don't, because when you look back to World War II, you look at PE revisions during bear markets. Actually, it is about a 33% reduction in PE ratios, and that would bring the S&P 500, based on 2022 earnings estimates, down to 3,400. If you also look to a couple of technical indicators such as Fibonacci retracements, the head and shoulders pattern, et cetera, that implies targets around that area as well.
Okay, Sam Stovall, CTA, technical analyst. Sam, are we in a bull market rally amid a bear market, or has there been enough catharsis to call a bottom and a new form of bull market?
I think that we're in a rally within a bear market. I think that this market could end up, as I mentioned, right now we just got back to average PE on forward 12-month earnings. And typically we traded a discount, significant discount, when all is said and done. So too many people, in my opinion, believe that the Fed will be able to engineer a soft landing as in 1994. But when you see the Fed funds rate 7.5 percentage points below headline CPI at the beginning of the rate tightening cycle, usually it's the reverse, where Fed funds is actually higher than inflation at the start of a tightening cycle. I think the Fed has a lot of catch up to play.
Given that, and given the fact that basically people are looking at very different outcomes in a downturn of what happens with benchmark yields, how are you using duration as a ballast or not, given what you expect to happen in the next couple of months?
Well, that's assuming that I know as much as you just asked. I would tend to say that basically when we're dealing with interest rates obviously are the key to intrinsic values. Our estimate is that, yes, we do trade above that 3% level for an extended period through the end of this year, and that will continue to put pressure on stocks. And it's usually the growth areas, in particular, consumer discretionary, communication services, technology, that feel the greatest pressure in terms of PE contraction during rising interest rate environments. And not surprisingly, that's why we see the inflation hedge, energy, as well as materials, and then also taking a look at staples and utilities as being among the stronger performers right now.
Sam Stovall of CFRA. Just on that final point there, Lisa, from Sam, and Sam, thank you, on the bond market. Just hearing more of that. Heard it from Morgan Stanley yesterday, this idea that we stabilise with a 3 handle. And we mentioned yesterday when we called up with Vishy Tripator that maybe that sounds unusual because so many people come on the programme and talk up this idea of slowing growth next year, which you'd think would bring down yields. I was just looking at the forecast on a terminal for next year on a 10-year. Q3 next year, 324, that's your median forecast. 324 for Q2 as well. So we're looking for that 324 range through the middle of next year.
And how much is this driven by real yields, right? I mean, this isn't necessarily that people are going to have such a different outlook for growth over the longer term or think that there's going to be more of it, but rather that the Fed is not going to be providing the same sort of stimulus. Oh, and by the way, when do we start talking about stagflation again? That kind of trend, stagflationary types of wins that really push back against growth, but allow inflation and yields to remain higher.
Or, John, with a vengeance, with slowing international growth, and maybe China doesn't pop like it's supposed to pop, money flows to the United States, price up, yield down, providing stability.
Dollar stronger, Tom. And whose problem is that this time around?
It's Japan's. Japan. Every pro I talk to, Japan is the elephant in the room because they're playing by a different rule book. They're sort of the Elon Musk of FX. They're playing by a different rule book than everybody else.
You want to call Kuroda the Elon Musk of FX?
No, I call Elon Musk the Kuroda of technology.
Okay, just to be clear on that. Yeah. TK, on a serious note, what on earth can they actually do if that's what we get more of? Yeah, what can they do?
They're going to have to do what they've done. They've got to expand the x-axis out a decade and go as deliberate as they can.
Equity's down 0.9%. There goes your interview with Kuroda, Tom, when he steps down.
Yeah, but my one with Elon Musk is front and center.
Yeah, very much so. Elon can't wait for that one. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Boris Johnson has managed to cling to power. The question now is for how long? The British Prime Minister survived a confidence vote by lawmakers of his Conservative Party. 148 Tory MPs voted against Johnson. That rebellion was bigger than the one suffered by his predecessor, Theresa May, who was ousted as Prime Minister 6 months later. The US has warned Kim Jong-un there will be strong punishment if North Korea conducts a nuclear test. Both Washington and the United Nations watchdog agencies say there are signs that North Korea could soon set off its first atomic device since 2017. Kim's regime has been test-firing missiles at a record pace this year. And shares of Target are falling. The discount retailer cut its profit outlook for the second time in just 3 weeks. Target trying to ease a surge in inventory by marking down more merchandise and cancelling orders. Operating profit will be about 2% of sales in the current quarter. That is well below the 5.3% that Target had estimated 3 weeks ago. And Elon Musk is threatening to walk away from his deal to buy Twitter if the company doesn't do more to prove its users are real people. But Bloomberg has learned that at the same time, both sides have been meeting and the deal is proceeding. Twitter reiterated it will hold Musk accountable to the terms of his $44 billion proposal. And Kohl's is in exclusive talks with Franchise Group for a deal that would value the retail chain at about $8 billion. Franchise Group's offer is for $60 a share. That has Kohl's surging in the pre-market trade. In February, Kohl's said it had rejected takeover offers because they undervalued the company. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The key metric right now that tells you households aren't really that worried about recession, saving rate is low. If people were worried about their income prospects, they wouldn't be spending so much out of their income.
That's one take. Vincent Reinhardt there, the chief economist at Dreyfus and Mellon. Here's another take. $4.92, your average gas price in America right now. Tom, I missed that. That's a big move in the last week. We're getting closer to 5.
John, this is convexity, acceleration. It's not the number. It's the way we're getting there and getting there rapidly. I really did not expect that 2 weeks ago.
And we're looking for 6 over at JP Morgan by the end of summer, Tom.
You know, there we are. Brent
Maybe things get worse.
Yeah, Brent crude 119 right now, down $1 from where we were yesterday. Lots going on this morning. Let's jump to it now. Oliver Chen with us, senior equity research analyst at Cowen. We usually talk to him about fancy sweatshirts at Celine. Not today. We talk Target, and we note that he teaches at Columbia Business School on retail as well. Oliver, I want to talk about the reality of Target, which is the Chloe ankle strap sandal is usually $16, $17, and you can go in there and for the kid, buy it for $13.59. If they lower that puppy down to $11.99, will they sustain the traffic that you say is required?
Well, Tom, what we have here is the consumers repositioned very quickly. So we had a cooler April, unfortunately. Anniversarying the stimulus was also an issue. And these markdowns taking place now are critical. Speed is the name of the game in retail, and Target is doing that now. The consumer shifted faster than they expected in terms of the consumer going out, requiring suitcases instead of swimsuits, and big and bulky in home. That's been under pressure too. So doing this quickly is a positive action, and markdowns will occur in the marketplace now this quarter. We're looking forward to a better back half, and Target and others execute well for back to school. Back to school should be pretty good. We are seeing a bifurcation in the consumer. On the one hand, there's lots of savings on the sidelines, but the consumer, the lower end consumer is under plenty of pressure, specifically the under 50K household income as inflation takes hold.
Oliver, this is what we want to talk about. You've touched on it in a couple of ways there. Has the strength of the consumer changed? Or is it just the basket that has changed? Or is it both? What is it?
It's a little bit of both, John. I think the consumer pivoted faster than retailers could plan for. So retailers had to be very quick and agile. In the case of home product and big and bulky, that's a very long lead time category. So it was difficult to shift. And Target and Walmart had executed so well through the pandemic, really stocking up to offer great customer service, that this change was faster than expected. What's really next? We still see a very strong luxury consumer. We also think a consumer focused on value, such as Planet Fitness, Grocery Outlet. Those are great ideas. And then, Tom, as we think in themes, our second major theme is health, wellness, and beauty. As you know, we like Ulta a lot. And then thirdly, digital platforms like Revolve.
It was nice of you to mention, Tom, when you started talking about health and beauty there, Oliver, and not me. Thank you, Oliver. Let's talk about Target a little bit more. And I want to talk about whether we should write down the quarter or write down the year. We touched on this a little bit earlier this morning. The stock's down 7.8%, but that's about the pain in the quarter. And arguably an investor right now that's just spooked, lost confidence in any guidance this company provides. But they are still looking for a bounce back in margins in the second half of the year. Now, Oliver, I want you to help us understand how doable, how achievable that actually is. When they're looking for 2% this quarter, that's the damage, and they're looking to get back to 6% in the second half of the year.
Yeah, Target has assessed the situation. They're out with that press release today, and what will happen is these markdowns and markdown reserves will drive the top line. We've been in a volatile situation with the compares and what's been happening with the consumer, but this should be a good glimpse into what's achievable and doable, and a reset which was needed in terms of what they're seeing now. So looking forward, the fixture is on unemployment. Unemployment's still very low at 3.6%, that is something we're going to monitor, as a risk factor to retail at large. But now the consumer's going out again, and this portfolio and the markdown should be in the right place. Target has unique vulnerability because keep in mind, grocery is about 20%. It's about 50% at Walmart, which has led to a little more stability in the Walmart numbers and guidance.
Oliver, how much does this challenge the model that came out of the pandemic, where a lot of companies, in particular retailers, were building up inventories to avoid getting caught up in supply chain disruptions?
Yeah, Lisa, what we liked about the pandemic in terms of retail is curbside pickup, these sortation centers, the integration of Omni. Those will be powerful tools for the long term, and also Target and Walmart running marketplaces. So there is a lot of positives that came out of building a better mousetrap for the long term.
Oliver, real quickly here, and we'd love to talk to you about luxury all the way on down to Target. We don't make light of it. It's really important. Could you explain to me why a sweatshirt at Target is $15 and a sweatshirt at Celine is $890? Explain that.
Well, Tom, the magic of retail, we teach it at Columbia, is magic and logic. Luxury goods really has a lot of emotional components that go into the good. And retail is about a willingness to pay model when it comes to apparel. What we also see happening is re-commerce and this move to sustainability. I'm here in Europe. It's a very big, important topic. So, Tom, I'd encourage you to look at resale. You'll get that Celine sweatshirt for 30 to 40% off.
Yeah, but what I know, John, which is so true, is they both shrink in the wash, which is my problem with Celine.
You are well aware of my particular predicament with that Celine sweatshirt. No, Oliver, it's what happens when the other half wants to wear your sweatshirt and deliberately shrinks it.
Yes.
In the dryer. That's what happens.
That's what happens.
That's what happened. Oliver Chen, a coward.
Thank you.
Oliver, thank you, sir.
Has the other half confessed to deliberately doing it?
We all know why she did it. We all know why she did it.
Has she
I haven't
defended
worn it
herself?
since. No, she laughed. She knows why it happened. So there we go. She's happy. Good for her.
Wow.
I'm trying to get it replaced. I'm trying to, one day, because Tom keeps bringing this up every single month, I'm hoping that one day Celine just take a listen and replace the sweatshirt.
They should.
Is that what you're pitching here?
Let's talk about Target just briefly and get away from this story. I think at the moment, a lot of people are trying to take a macro signal from one retailer.
Yes,
or
yes,
maybe
yes,
a couple of retailers.
yes.
But when you speak to the retail analysts, it's so much more complex than
Yes.
just that. You ask them just direct questions, and we did it. Is this a change in the strength of the consumer or just a change in the basket? And they'll often tell you it's a bit of both at the moment. It's a change in the basket, which is why I keep bringing up the airlines too, Tom. When you ask the airlines the health of the American consumer right now, it's pretty decent, right?
Right.
The price tolerance is sky
Above
high.
nominal, yeah.
Ask a retailer, different story.
Well, it is, but this is what we're trying to do, folks, is we don't want to go into general macro hyperbole. We want to go beneath the analyst headlines into what's actually going on at Target. To me, John, again, to be optimistic, Target's going to clear these challenges quickly.
I wonder how quickly today. Keep bringing this up, Lisa. If you were trading on the back half that things get better in the back half of the year, what happens to this stock? Who wants to buy this? I'm going to be looking for that going into the close.
How can you get confidence twice in 3 weeks?
Really hard.
Downward projections and forecasts.
Really, really hard. I'd be spooked.
This is incoming.
The whole market was 3 weeks ago, remember, when Target first came out with this.
I got a message in, John. Does the AC Milan jersey shrink in the dryer?
It doesn't cost as much as the Celine sweatshirt, let me tell you. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance. Your equity market lower, -0.8% on the Nasdaq 100. We are down by more than 1%. Yields coming in a couple of basis points. Call it 3.0122% on a 10-year. And the main event's got to be Target. If we can take a quick look at the name, the stock lower in early trading, lower by a lot as well. Off the lows, that's the good news. The bad news is we're still down by more than 7%, Tom.
Yeah, it is. It's going to be interesting to see. This is a lot of fun right now. We're going to do this here to keep the dialogue going. And I really want to focus on the CPI report that we're going to see on Friday. David Page joins, head of macro research at AXA Investment Managers. And what you don't see, folks, when we're on break is David Page and John Farrell come from some neck of the woods, and they were just reminiscing about the 3 or 4 day Jubilee as much as they could. And, you know, we're going to keep up this dialogue as well. Is inflation the same, David Page, in Middle England as it is in Middle America?
It's similar. I mean, we're getting much more pressure coming through from utility bills, so household costs, rather than from petrol or gasoline costs. So that's where the pinch comes differently. But energy is still energy. You're still getting that problem coming through. And services are starting to grow. You've got very tight labour markets for slightly different reasons, but tight labour markets in both. And that's feeding through to some of the services inflation as well.
Not the most mail I get, but pretty close. And as simple as I can, economists talk about core inflation. We are living nominal top-line inflation. When are we going to stop doing that and start looking at 8% inflation?
Yeah, no, headline is what's key at the moment. And it's not only key because it's what's driving real disposable incomes, and it's the squeeze that we're feeling on the consumer, which is very similar in the UK, to a slightly lesser extent across Europe, but very similar in the US. So it's very important from that real disposable income point of view. But it's also inflation expectations, and that's what's got the central banks worried. So people, you know, the man on the street doesn't look too much at core inflation. They're worried about headline inflation. They are worried about petrol prices or gasoline prices, and that's what's going to drive inflation expectations higher. At the moment, it's not happening. There isn't a big increase in medium-term inflation expectations. People are pretty comfortable with the institutions, albeit they know we're in for a brutal shock over the next couple of years. But that headline is the focus, I think.
David, how concerned are you about that that study that came out yesterday. When you took a look at the 1980s inflationary wave and adjusted it to the spending habits of today, you got something very similar to what we're looking at now. The peak, as calculated by this study with Larry Summers that came out yesterday, June 1980 was 9.1% versus the 6.2% CPI print that we've seen on the core level. Do you view that as a likely comparison that gives a sense of how much work the Fed has to do and whether we're going to head back to a Volcker era type of circumstance?
Yes. I mean, I think the Fed's first interim target is whether or not it can control the outlook for domestic inflation. I mean, very clearly the reason we're here is from a lot of external shocks, and that's the case for a lot of the economies. But you've got oil prices, which may well go higher over the summer. You've got the potential for a gas problem coming through in the fourth quarter, and you've got supply chain issues. Now, the Fed can do little about that and probably won't worry too much about that. It will assume over the next couple of years that those issues will fade back. What the Fed has to worry about is the fact that the domestically generated inflation is so high, and that's coming from a tight labour market. Now, from that perspective, what they need to do is slow the economy, and they need to gently raise unemployment. But we all know what a double-edged sword that is and how successful the Fed has been at making that very fine-tuned adjustment over the last several decades. So it's a huge challenge. And I think over the summer, particularly as markets try and second-guess exactly what the positions are going to be, it's going to be very difficult for the Fed to keep the markets exactly where they want them, tight enough to slow the economy, but not so tight as to tip them into a more outright recession.
And part of this is how quickly the Fed wants to get inflation back down to that 2% target. We've been talking about this for months, about whether they're going to be okay with 4% at the end of next year, or even 5%, or whether that will be a little bit too slow of a decline for their comfort. At what point do you see them thinking, okay, this is an appropriate pace, 4%, 3%, or does it have to get somewhere closer to 2% by the end of next year?
No, I don't think they can look for that. I think it's going to be very you'd see a very sharp adjustment to get it coming back to that sort of level. So I think they've realistically got to be looking at getting inflation back on track by 2024. So they've got to be confident in their forecasts that inflation is going to be back to target in 2024. And that probably doesn't mean that you get anything like that in 2023. We're forecasting, roughly speaking, to see CPI just a little bit above 6% by the end of this year. And that's assuming we don't see too much of an energy shock at the end of the year. And then probably getting down towards just over 4% by the end of next year. So it is going to be quite a slow process when you look upwards. But we're coming from 8.5%, possibly higher. So we are going to be looking at inflation falling back quite quickly. It's just that it's going to take a little while to get back to target.
Where's the value opportunity here? We've had a repricing of any given ratio you want to look at. Is the value opportunity the United Kingdom? Is the value opportunity America or continental Europe?
No, I think we might have to look even further afield than that. I mean, I think Europe is going to be a real risk over the next 6 months just because of the risk of the energy shock. We really don't know what's going to happen militarily in Ukraine, Russia. We don't know what's going to happen with the gas shock.
So where are you going?
So then we start thinking a little bit further beyond that, and we're looking, to see whether or not emerging markets can make some pickup.
So critically, do you need a weak dollar to own EM optimistically?
I think you need the dollar not to be moving up higher from here. And I think, the risks are that as we see those risks emerge, particularly if we see anything nasty happen in terms of China COVID again, things are looking okay for now. But as we've seen with Omicron on a number of occasions, it picks up again quite quickly. If we see risks in multiple parts of the world, that's what tends to see the dollar pick up even above and beyond, what we'd expect in terms of fundamentals.
What's your most contrarian call, David?
What's our most contrarian call? Well, I think we're at the moment, it sounds like our most contrarian call is that there's no preset path for recession in the US. We're hearing a lot about the early doors of the straws in the wind of a recessionary period coming through. But I don't think there's anything at this stage that commits us to an outright recession. It really does depend on whether or not the Fed, how the Fed manages expectations over the next couple of meetings. So our view at the moment is that we avoid recession, but that probably means that the Fed stops much sooner than markets are thinking. We think that by the end of this year at 275, the Fed will have to stop. And that's not necessarily because the Fed is materially above a restrictive rate or anything else at that point. It's primarily because we think financial conditions are going to be tightening quite quickly over that final half.
Do you actually think that that's out of consensus? Do you think that currently a recession is being priced into U.S. equity markets, given the reaction that we saw to Target's revision further downward?
No, genuinely not. But listening to your show all morning, I think, there's a lot of talk about recession coming through, and I want to get it out there.
Look, honestly,
I almost spat out my water then.
that was a fair
Carry on, Lisa.
comment. But what people say and what they do are two different things. Are you saying that there's sort of an overly bearish sort of tilt to some of the Wall Street analyses and perhaps some television shows, and that perhaps in reality that's not what people are baking in the pricing of assets on the ground?
Yes, I think that at the moment there's no pricing for a recession, but I think everybody recognises that it's totally doable. I mean, I think it doesn't take too much, and I think when we see Fed Chair Powell speaking in a week or so's time, I think he is going to have to be a little bit more hawkish than markets are expecting, and that's going to tighten those conditions again. We've had a little bit of a relief rally, I think, in terms of what the Fed might do over the last 3 weeks, and I'm not convinced that that's going to be the message the Fed wants to leave us with.
In the break, I was getting all misty-eyed, folks, over Warwickshire, and, David Page and John Farrow doing it up. And so, John, I dive into Coventry Live, and they're not even talking about Coventry. They're talking about Cardiff and the Tots and where Gareth Bale is going to land.
Is that the lead story, Tom?
It is. That's the lead story in Coventry, is Gareth off to Cardiff.
I think you're more interested in that than the people of Cardiff.
I don't. I mean, Blanchflower away on this, I'm sure.
He's got his country into the World Cup, Tom. Fantastic.
It's great. I mean, the motherland is going to go to the World Cup, and that's fine. But, John, importantly here, does Bale go and be a national hero and drag Cardiff back to Premier League, go up a league, or does he go back to the Tots and come in for 5 minutes and save the day?
I really don't know. I mean, given the project that Antonio Conte is trying to build, I'm not sure where Gareth Bale fits into that.
Yeah.
That would be a one-year transfer.
David, thoughts?
What's amazing, David, is that he's only 32. He's 33 later this summer.
Yeah, I mean, his career is a mystery. I mean, at some point somebody should have said to him, go to a team where you are going to play, because you're going to miss those years for so many, when you grow out of this.
John, that's what Lisa said to me in Davos. I overheard her in the restaurant.
Go
she
somewhere
said,
else.
Tom, his career is a mystery.
It's a mystery. You should go somewhere else. David Page of AXA Investment Managers. David, thank you. As I almost spat out my water, it just reminded me of something.
Oh my God, you didn't
I'm not going to name the guest. It would be so unfair for me to name the guest. I just remember the three of us were sat in a radio studio in February 2020, and a guest came in and looked at the three of us and said, "You're just so depressing this morning." It's just so depressing. Do you remember this?
Yes,
do you remember
I do remember this.
It's just so depressing. Things are going to be so much better than you think they are. And wow, they were so much worse, Lisa.
Hold on a second. But I also think that, honestly, sometimes, Tom, you'll say to me, "Oh, you sound so bearish." I'm not so bearish. Sometimes I'm just asking questions. I mean, sometimes I'm just trying to find out where the holes are in certain people's optimism, where the corners are.
When you ask about the balance of risk, they're predominantly about the downside risks and not the potential for upside risks. Is that fair?
Maybe.
Do you want to get some price action?
Please.
It's always available. Futures are down 0.9%. I needed some of that earlier. The Nasdaq down by 1.26%. We're pulling back once again as Target spooks investors just a little bit once again. If you experienced this 3 weeks ago, it feels familiar. It's because it's happening again in 3 weeks, twice. Target has had to cut the profit outlook, and the stock is down, and down hard in the pre-market. Off the lows, we were down about 10% of the lows. We're down by 7.4% now. That's a single name story. That's one stock, but it's one fear too, that this is more than just Target, Tom, that this is a bigger story. And we touched on this briefly moments ago.
Yeah.
It's tremendously difficult to get a macro signal from these guys right now, because when you listen to the signal from the C-suite, when they talk about their company, they don't talk about the strength of the consumer. They talk about the changing basket of the consumer.
Yes.
That's different than just saying the consumer's weaker because inflation is higher.
And the problem I have with the media gloom on recession is, as one of our guests mentioned, maybe Vince Reinhardt, there's discussion of a growth recession which hammers certain deciles harder than others.
David Malpass is going to weigh in on this, that the president of the World Bank in the next hour
book Blanchflower
on Bloomberg TV. Danny will be on soon. He's very upset about these recession forecasts. He's basically saying it's guessonomics, and here we are. The weakness is here right now. It's not round the corner. Danny's got a lot to say. Doesn't think the Fed should be hiking either, Tom.
Yeah,
Shocker.
We know that. He's dovish.
We do know that. Down 3 basis points on a 10-year, 3%, just about. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Boris Johnson is trying to draw a line under the controversy that's been threatening his leadership, but the scale of a mutiny against the British Prime Minister suggests his days may be numbered. Johnson survived a confidence vote by members of his own Conservative Party. Still, more than 40% of Tory MPs voted against him. Johnson now says it's time to get back to helping people with the cost of living. Hong Kong won't tighten coronavirus restrictions before the city's July 1st handover anniversary. That's according to Chief Executive Carrie Lam. There's been speculation that China's President Xi Jinping might attend the celebrations. Hong Kong's COVID cases have been rising since the city began rolling back social distancing curbs. And tourists visiting Japan may be sent home if they don't follow rules on wearing masks and sanitizing their hands. They also must buy private health insurance. Japan is set to allow package tours starting this Friday. Borders have mostly been closed to tourists since early 2020. Citigroup will hire about 3,000 employees for its institutional business in Asia. The new staff will work in areas including investment, corporate and commercial banking. The bulk of them will work in Hong Kong and Singapore. There will also be new jobs in India, South Korea, China and Australia. Apple has unveiled the most significant overhaul to its popular MacBook Air laptop in more than a decade. It features a fresh design, new colors, and a speedier processor from its homegrown line of chips. Apple showcased the MacBook Air at its annual Developers Conference. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be
mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think the White House's message is pretty good. They are clear that inflation is high and that it's hurting. They are clear that the primary responsibility for bringing inflation down is the Fed, and they're clear that it's not going to be coming down instantly. I appreciate and admire that Secretary Yellen said that she made a mistake. I think we should have more confidence in her for her willingness to admit error.
Jason Furman, who visited us in Davos, and that is a tour de force interview. And if you would like more of this in the Wall Street Journal today, Jason Furman does what he is famous for, which is lining up the ducks with immense precision, confidence, and intellect as he compares inflation in the United States with the things in Europe that are going on as well. Really can't say enough about it. Part of that is the indicator of what the tea leaves are doing, including week yen. Kriti Gupta on yen.
On yen against the Australian dollar, or I should say the Aussie dollar against the Japanese yen, which, Tom, is my favorite risk gauge when you look at what the implications are, what direction it's pointing to for things like the stock market, like high yield spreads, for example. The Australian dollar having that strong correlation with commodities and commodity exports, of course, the Japanese yen being that strategic haven for decades and decades. And that brings me to my chart of the day. We are looking at that currency pair going back to 2020. And really, you see this trajectory that looks a lot like the stock market until you come to November 2021, which is really that peak that you saw in the stock market before you had this big bear market that followed. And look at what the Australian dollar versus Japanese yen is doing. To our radio audience, it's going up, 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 while the stock market went down, 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 except in the last couple of weeks where you have seen this reversal. The question, though, is this reversal that you're now seeing in the stock market and the currency market, how much of that is coming from the signals of the RBA and the BOJ? Of course, we know the RBA also hiking rates unexpectedly by more of a margin overnight, Tom.
Kriti Gupta, thank you so much. Barry Ritholtz is far too young to remember the miracle of C.J. Lawrence research and one Edward S. Hyman. It was absolutely original, the granularity of Ed Hyman in parsing out inflation. And instead of the Friday inflation report, which is above the headline, maybe with a little treatment on apparel and other things, Barry Ritholtz has been looking at the microdata of inflation. Barry, what do you see?
So, it's interesting that everybody is so focused on what the Fed is doing to fight inflation, but the vast majority of what we see is still the hangover effect of the shift from a primarily services-based economy to a more heavily goods-based economy during the pandemic. We're still untangling the mess that created, and that has nothing to do with where the Fed is putting rates. That's going to work its way. The pig is working its way through the python, and it's going to take a while before that finishes resolving. I like to say transitory is taking longer than expected.
Okay, it's longer than expected, but the answer is we've got a core inflation of 6%. What is the makeup of that core inflation?
So a lot of that is obviously food and energy, which was already elevated before the invasion of Ukraine, which sent those prices even higher. We're going to be dealing with this for as long, elevated prices, at least in part for as long as that war continues. But, when you look at how the economy shifted during the lockdown, and then, so you had a surge in demand for goods during 18 months, and then we reopen, and now there's a surge in demand for services. So when you look at airline tickets or vacation, try to get a hotel room in New York City, we went from one extreme, which was a 20% increase in demand for goods, which really tied up all of our supply chains and made a lot of pre-existing issues much worse. Now we're seeing the reverse of that. And since there's only so many seats on each airplane, the response is we're going to raise rates. The same situation we were dealing with goods during the lockdown, we're now seeing in services as we're reopening.
Barry, why have markets gotten this so wrong, as we can see by the share price reaction to Target, frankly, to Walmart, to Amazon, adjusting to the shift?
You know, it's always challenging to get the timing right. I mean, who didn't expect to see companies ranging from Netflix and Amazon to Peloton, Walmart, Target, et cetera, and we could throw in, you know, when will Home Depot and Lowe's suffer the same effect? It's easy to look at it in hindsight and say, well, of course we should have seen the demand fall would affect these companies once we began to reopen. Once we began to reopen, the reality is a lot of these companies began to fall in anticipation of that. I can't tell you when Home Depot and Lowe's are going to peak, but I would guess it's going to be before we see the top in real estate. Markets tend to anticipate this by a long while. It's the timing that's so challenging. So I think the market sniffed this out in advance in a lot of companies. It just didn't get it perfectly.
Barry, perhaps we're not going to head into a recession, and we're not in a recession now, as everyone agrees. Almost everyone, I should say. Almost everyone. There are some outliers. Are we going to see an earnings recession, though, given the inability for some companies to get ahead of the shift in buying preferences?
Yeah, heading into the pandemic, the entire 2010s was a fantastic period for earnings growth. And while a lot of people blame or credit low rates by the Fed for causing this spike in revenues and profits, you know, you have to give a lot of companies credit for really hitting their stride post-financial crisis. Yeah, low rates are a factor, but it's only one of many factors. And then to see how everybody pivoted during the pandemic, you know, a lot of companies did a lot of things right when we were in an uptrend. Now it becomes a whole lot more challenging.
Barry, thanks so much. Barry Redholz for the update today. Masters in Business, just a terrific column as well for Bloomberg Opinion. Lisa, VIX out of stick, S&P futures at -40. Lisa, I just looked at yen, which has, of course, been my focus today. The yen weakness, going back to the depths of the 2008 crisis, is a depreciation of 40%. It has just broken through to new lows not seen, new weakness not seen since 2015. This is a backstory which is going to be front and center in months.
How much can they continue to diverge from a rest of a world that is moving to a decidedly positive nominal rate structure? They are still deeply negative in both real and nominal levels, and they are committed to it for the time being because inflation isn't picking up the way that it is. I want to point to this, talking of dollar strength. The trade balance. This is interesting. We actually saw an unprecedented reduction in the trade deficit in the United States in April, in that data that came out at 8:30. The reason being imports from China were down dramatically because of the closures, because of some of the restrictions on the ground. This just shows how quickly moving this economy really is.
And if China opens, how does that adjust the trade deficit?
Exactly.
I mean, the 87 billion statistic now is still highly unusual off of the shock of what we saw the last go-around.
Deeply negative. And so how much does that continue to persist and deepen once it opens?
It's required, folks, that we end Bloomberg surveillance with the phrase deeply negative, because we are a deeply negative show. Thank you, Professor Blanchflower, for watching. We'll be all Cardiff with Blanchflower here in a bit as well. Stay with us through the day. It is the most interesting and, of course, a focus on Target, on radio, on TV. This is Bloomberg.
SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
You've seen this movie before, haven't you? It's Target, the sequel. Equity futures negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, profit margins taking center stage.
There's so many pressures on margins. Businesses feeling the pressure of lower margins.
The market needs to price in a change in the profits outlook.
Who's able to hold on to margins?
Listen to the CEOs.
Listen to what CEOs are saying in their earnings calls. They're very cautious.
It's a long list of companies that are freezing hiring and or cutting staff.
You're seeing all these CEOs, their confidence is waning.
You're going to see some downward revisions.
I mean, you saw the targets of the world. I mean, the stock was absolutely crushed.
They can't push this inflation in their base prices onto consumers.
Those tail risks are still really elevated.
There's a long list of risks surrounding this market.
You have to look at those and think that the sharks are circling a little bit.
Katie Lyons, I'm pretty sure I watched this movie play out 3 weeks ago.
Yeah, this is happening in rapid succession, John. A really negative surprise for Target just 3 weeks ago, followed by the second cut to its profit outlook today. So a stock already down 31% year to date is lower by another 7% in pre-market trading this morning, as it now says that its operating margins for the second quarter will be around 2%. That is down from the previous guidance of a range around 5.3%. Now, I will say they do think this gets better in the second half. Somehow they expect operating margin will rise to about 6% in that later period, but clearly investors have some doubts about that this morning. The problem for Target, John, is that demand is shifting rapidly in the face of inflation towards things like staples and away from discretionary categories. And the company finds itself with way too much inventory for items that consumers no longer want. Now, how does it solve that? It says it's going to try to cancel orders, cut down on those, and mark down more for excess merchandise. So basically discounting is coming. Things are going on sale, John, and obviously that means less profit. Target also says it plans to take other actions like adding storage near ports and adjusting prices to offset high transportation and fuel costs. But as we've seen from some retailers, the ability to exercise that pricing power and pass those costs on, getting more difficult as a consumer becomes less tolerant of higher prices. And of course, Target isn't the only retailer grappling with inventory issues either. We've seen buildups really across the board to the tune of 30 to 40% for the likes of Walmart, Home Depot, TJ Maxx, you name it. And of course, it raises a question as to whether some of these players too will also have to start discounting in order to get those inventory levels down. Although one analyst, John Zalaitis, president of Quo Vadis Capital, saying this morning that this seems to be an internal Target issue, that this is a company that has just grossly mismanaged its inventory, John.
Kelly, that's the number one issue for a lot of people. Is there a broader macro signal here? Or is this just about a single name? And Kelly, you mentioned one word twice, discounts, markdowns. This is not going to be an inflationary story. This isn't about passing on higher costs because of higher costs. This is different.
It is different. You're trying to get the consumer to buy these discretionary items that Target now has a lot of, that as a consumer faces higher prices for groceries, gas, maybe they're less willing to go out and buy that television, John. And for Target, a discount retailer that caters to the lower end, it might mean having to meet them where they are.
The stock is down 7%. Kelly, thank you. Joining us now is Nuveen's Tony Rodriguez, Zach Griffiths of Wells Fargo. Zach, first to you, how difficult is it to take a macro signal from this name here, from Target, and from other retailers in America too?
It's tough because it's a story that we heard once and we're hearing again, as you outlined at the start here, John. And to us, perhaps these markdowns become a bigger part of the story from an inflation perspective, from a more macro perspective over the next couple of months, but we're really not seeing it right now. And when we think about what we expect for inflation on Friday, which is certainly key for the monetary policy outlook, we expect inflation to show that it is not coming down slowly. So it's kind of tough to square the message from Target with what we're seeing and expecting from the macroeconomic data, but it's definitely something we'll be keeping an eye on going forward.
Tony, when you look at this, is this a change in the strength of the consumer or just a change in the spend, a change in the basket and what goes into it?
Well, good morning, Jonathan. Good to be with you. And I think it's actually a combination of both. I think the bigger portion is the change in spend, as we are now kind of much more reopening is occurring and people are shifting from goods to more experiences and services. I think that's the biggest read-through. But I think part of it is also just a lower amount of spending given the higher prices that we're seeing across the board, but especially in areas that really hit the pocketbook quite a bit, whether it's in, energy prices, food prices, et cetera. But I think you saw that, for example, also in housing. You've seen some decline in housing activities as a result of, higher rates, Fed activity, et cetera. So I think it's a little bit of both that is the read-through for the broader economy.
Tony, this is the composition conversation. Let's have the conversation about speed. It's only 3 weeks ago they did the same thing. It seems to me that a lot of corporations, and not just retailers, across industries, Tony, are really, really struggling to get a read on demand in this economy, where it is and what that demand is for. What do you make of that?
Well, I think it's partly what the Fed is hoping to achieve here, and that is a decline in aggregate demand. They clearly are looking at inflation that is well exceeding any levels that they're comfortable with. The tool that they have to battle that is not one that can affect supply chains, not one that can affect energy prices, but it can affect aggregate demand. So as they are, started on the rate hike cycle, but the market has fully priced in a substantial amount of rate hikes, you're seeing that impact on aggregate demand. So I think that the bottom line is we expect a slowing in the economy as we move through the year. This is one example of how you start to see that play through in, companies, retail here being the example.
Zach, you've got a different view on this. You think inflation can persist and yields can go higher. Walk us through it.
Yeah, Jonathan, everything that we're seeing, at least in the macroeconomic data, suggests that inflation is very broad-based and you are getting additional difficulty from the energy side of things, which will be more of a near-term story. But to us, it just shows that the Fed is going to have to go more aggressively than the market is priced for. And when we think about where the market is from a terminal rate perspective, it looks to be around 3.25 in June of next year, give or take. We think that's way too low. Something like 3.75 to 4% is what the Fed is going to need to do to really bring down this inflation that we expect to be very persistent. And so we expect the market to converge on this view over the next 2 or 3 months as we see these inflation prints really get stuck around 8% from a headline perspective. And that's just not a situation that we think lends itself to the Fed slowing down, stopping and looking around. None of that. We think they have to keep going 50 basis points at least through September, and that's going to flatten the curve and raise rates across the curve, but driven more by the front end for sure.
Zach, you said two big things there. We get stuck at 8%. The Fed's got more work to do. Fed funds gets closer to 4 and away from 3. Run me through the Treasury market. You talked me through the shape of the curve. I want to talk about levels. Where are we going through the front end out to the long end?
So we think the 2-year yield could hit 350 by the end of this year. And when we think about the back end of the curve, we see supply and demand dynamics, at least in the near term, not lending itself to such a big rise. So let's call it 325 on the 10-year. If you want a midpoint, I'd say the ranges around those midpoints are pretty wide, as there is still a lot of uncertainty in the outlook, but that's how we see things unfolding if our call for inflation to remain persistently around this 8% number is correct.
Tony, what's the counterpoint to that? Getting stuck at 8?
Yeah, so our view is that, we're not that far off on a 10-year forecast, but we think kind of a 275 to 3.25 is a range for the end of the year. We'd put a point estimate at 3%, but we don't think the front end gets quite that high because we do think the Fed will be able to back off. Some of the things that we're seeing with respect to inflation, which is the one-factor model that the Fed is using right now, is that we are seeing, for example, some improvement in the ISM when you look at some of the supplier deliveries and backlogs, for example. And one of the key things is average hourly earnings. And you saw that come in at 0.3% last month. But if you look at a 4-month annualized, back in January, that was 6.3%. And we look at it today, that's down to 3.8%. So we're already seeing some softening in the wage pressures. And again, it's way too early to call it mission accomplished. But we do think that as we move closer to the fall, the Fed may be able to back off from these 50 basis point hikes to a 25 basis point hike cycle. And that will prevent the 2-year from, we think, reaching that 3.5% or higher level.
Tony, that's the hope. A lot of people share that hope. I hope you're right. I hope that we can get to that soft landing and the economy is going to be okay. When it comes to risk assets, I don't have a view. I'm going to ask this of you, though, Zach. Can you make the case for risk assets if we haven't seen the high in yield to the Treasury market?
It's certainly a difficult backdrop for risk assets to perform well if yields are going to continue rising. And when we think about what the big driver of the increase in yields will be, it'll be on the real yield side of things as the Fed tightens policy more aggressively and the market starts to price in a more aggressive Fed. So that is a difficult backdrop for risk assets in our view, as it signals a tightening of financial conditions. I think that the U.S. consumer and the manufacturing sector has shown some bright spots more recently, and it's tough to juggle these different data points, whether it be from a micro perspective, from earnings, or these more macroeconomic data factors. But to us, we think that the consumer can hang in there. And when we think about economic growth over the next couple of quarters, it's going to remain at or above potential. And that's just not a situation where the Fed can slow down. So that's definitely going to create a difficult backdrop for risk assets over the next 6 months, let's say.
Zach and Tony, sticking with us, your equity market looks like this. 20 minutes out from the open and Bell equity futures down about 1% on the S&P, on the Nasdaq 100 down by 1.3. Abby, it's all about one name, isn't it? It's been about Target for the last few hours.
It is certainly all about Target. Shares down sharply, and it really feels like Groundhog's Day, to the point that you and Kaylee were making earlier from just 3 weeks ago, because this is the second time that they have slashed profits and operating margins for the second quarter in about 3 weeks. They're now expecting that operating margin at about 2% for the second quarter. The average analyst above 6% for the second quarter. So just too much inventory, that bloating. This means profits down, of course. And the stock now set to open down about 45% from last year's peak. Really very brutal. It's weighing on other names, too. Now, the big question that you both were talking about, is this a macro issue or retail specific? It seems a mixture of both. Macy's has talked about a little bit of bloated inventory relative to pandemic attire. They were caught off guard by the desire for going out type clothing. That stock down 2.4%. Walmart, of course, a couple weeks ago, a very similar situation to Target, where their last quarter was pretty good, but the outlook relative to operating margins not great because of rising inventories. Best Buy down 4%. But, John, there is one bright spot, and of course, Kohl's also reported a brutal inventory, but that stock up 8%. This on the news that they are in exclusive talks with Franchise Group over an $8 billion bid. They have 3 weeks to work out the details, but with that stock soaring up about 20% after its disastrous quarter bottom, it seems as though investors, traders, optimistic maybe it happens.
Abby, thank you. This Target story is really complex, really difficult to get your head around because things have changed so much in just 3 weeks. It's the second profit outlook cut. For anyone looking at this particular name right now, are we writing down the current quarter? For them we are. Well, we're writing down the whole year because we don't have confidence in their guidance for the second half as they forecast an improvement as this year continues. For now, at least, Target's down 7.5% following a big drop in the last month. Coming up, a host of primaries putting the spotlight on the midterms.
We understand that prices, these gas prices, including food prices in particular, this is hurting families, especially as they sit around their kitchen table. But we're going to continue to do everything that we can.
The White House continues the fight against surging prices. That conversation up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Understand that prices, these gas prices, including food prices in particular, this is hurting families, especially as they sit around their kitchen table. But we're going to continue to do everything that we can. The rescue plan has really been able to help us put us in an economic place where we're stronger.
Paying at the pump, we have a new number, $4.90. The average gas price in America getting closer to $5 a gallon. Drivers in California, they're looking at a 6 handle. This building the pressure, keeping the pressure on President Biden with the primaries kicking off in 7 states. With us now, Emily Wilkins and Mike McKee. Emily, first to you, how big is this story? Inflation, price pressure, food, energy, and all the rest.
John, this is the story of the November midterm elections right now. And while the primaries that we see today, we're going to learn a little bit more about the direction that individual parties are going within the primaries. The overall story for November is very much inflation. And you see that in how the White House talks about it. You see it in how Democrats talk about it. And you sort of see that they do try to change the narrative a little bit. They try to not talk about inflation, but talk about unemployment, not talk about inflation, but talk about lowering prices. And the reality is that there's really only so much that the Biden administration and Democrats can do to get these prices down, but it's very much impacting Americans, and it's giving Republicans a lot of confidence in a midterms year where they were already expected to come out ahead. This is just the wind at their backs at this point.
Mike, this conversation at a time when we're actually looking at Target selling down inventory, marking things down. Put those two things together for us, Mike. You've got this big inventory build-up for some of the retailers. They're going to have to aggressively sell some of these goods now at a discount. Then at the same time, you've got energy prices pushing ever higher, day after day, week after week, month after month.
And we've got CPI coming out on Friday, and the good news for Jay Powell is those sorts of things are bringing down core inflation. We're expecting it now to have a 5 handle, come down from 6, and that would be the Fed's target, what they're trying to get to. But the bad news for Joe Biden is Mr. and Mrs. America don't really care. What they're caring about right now is food and gasoline prices. And food prices, can't do anything about that. You got to talk to the weatherman, and you got to talk to Vladimir Putin about bringing down food. And look at what's happening with gasoline. We saw a brief drop down in April as gasoline prices flattened out. What's happened since then? You can see the yellow line. It's going to be bad on Friday. Headline is going to be bad news for the White House. Now, the reasoning behind this, and where Joe Biden gets treated a little unfairly, is that we don't have the gasoline refining capacity. They can get all the oil they want from Saudi Arabia or from the Strategic Petroleum Reserve. But right now, our gasoline refining capacity has dropped significantly. A lot of plants mothballed during the COVID crisis because everybody thought we'd be switching to renewables. And that means production of gasoline is down, supply and demand. There is less supply, demand still strong, prices keep rising.
Mike McKee, Emily, thank you to you both. It's painful, and it could get worse. Goldman Sachs yesterday evening putting out this research note. Jeff Curry and the team with these numbers. Just listen to these numbers. 140 over 3 months for Brent. That's their 3-month price target. For WTI, 137. And even if you go out 12 months, they're looking at 130 on Brent. They're looking at 125 on WTI. Tony Rodriguez, Zach Griffiths, back with us. Tony, are you modeling those kind of numbers? 140 over the next 3 months, 137 on WTI?
Well, we don't think that that's going to be an equilibrium level for oil prices, but we certainly think there's some ability for oil prices to hit that level over the next couple of months, given all of the volatility and uncertainty in the energy markets right now. As a longer-term measure, no, we're thinking that we're going to be in this, kind of triple-digit, but low triple digits, call it 100 to 120 for the average for the balance of the year. But then next year moving into a lower level than that, maybe getting back to below 100. So not modeling the 140, 150 for any extended period of time.
Zach, does that smell like demand destruction to you?
Yeah, that's going to be a big issue, I'd say, and we don't have that priced into our outlook for inflation. We think that oil generally comes down gradually from the levels that we're at today, so that's definitely at odds with us. And to me, it bodes the question, would the Fed look through that and its impact on the broader inflation measures, the headline inflation measures, I should say? Perhaps they do, but to me, it kind of just spells more issues, not only for the Fed, but for the U.S. economy, if that were to come to pass.
Zach, how would you characterize the current relationship between what happens in the commodity market and what's happening with treasuries?
It's certainly an interesting dynamic to keep an eye on. And when we think about sort of what's been going on with how yields have risen, you've seen a lot more of a pickup in real yields recently. And if we do see these oil prices start to come up, we could see break evens start to rise again, maybe even back towards the highs of what we saw earlier this year. So that's definitely a dynamic we're going to keep an eye on. The Fed does not want to see break evens come back up. They've already bounced a fair bit, at least on the 10-year break even. The Fed would much rather see that come down and see that inflation expectations are starting to respond to their policy actions. So if you have that water muddied by a big increase, even from where we are today in energy prices, that's just going to be more of a headache for the Fed.
140, 137 on Brent on WTI. These are big forecasts. Brent crude right now 119, WTI 118. Tony, when you think about where you want to be in credit and where you don't want to be in credit, how much does the energy story influence that?
Certainly from a sector composition of your credit exposure, it influences. We have been relatively positive on the energy space, materials this year. So having overweights to that makes sense in the context of these energy prices. If you start modeling in 150, then I think both the demand destruction that might come from that and the Fed policy response, which would mean a certainly higher ultimate level of the Fed funds rate and the aggregate demand destruction that would bring along, I think that has to temper your view on where to position from an overall credit perspective.
Zach, it's almost like a double timing, isn't it? Crude goes higher, it hurts the consumer. Crude goes higher, and this Fed has to go higher too. At some point, does this Federal Reserve have to start responding to what happens with the output numbers, even if inflation persists? Zach, let's talk about your world and finish there. You think that this 8 number, we get stuck there. But what happens if the economy starts rolling over with that 8 number still sticky? What does this Fed do, Zach? Do you understand the reaction function of this Fed if that's the scenario they face?
Everything they've indicated up to this point is inflation is the #1 priority, and I just don't think they're in a position to respond to growth concerns proactively or even that quickly reactively if we do get these inflation numbers like we're looking for. So the Fed's in a very tough spot, but at the end of the day, if they aren't really seeing any material progress with inflation moving downward, I think that is what they're going to remain focused on, and perhaps it means a recession is necessary to bring this inflation down. That's not an outcome that anyone wants, but I think the Fed is probably at this point willing to risk that in order to get the inflation situation under control, as opposed to responding more proactively to a slowdown in growth or perhaps even a big hit to risk assets. So it's a tough spot, but we do think inflation is #1. The Fed keeps tightening, and it's a difficult backdrop for the U.S. economy and certainly for assets.
That's the scenario that Deutsche Bank are forecasting, a messy one, a recession ultimately by year-end next year. Zach, wonderful to catch up, buddy. Zach Griffiths, Tony Rodriguez breaking down the bond market for you, and the equity market too, as we get some numbers from Target once again, a familiar story. Futures down by 1% on the S&P, on the Nasdaq down by 1.29. Coming up the morning calls and later, Wall Street divided on the bear market rally debate. BlackRock's Kate Moore will chime in, and we will hear from the World Bank President David Malpass. That's coming up shortly. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Minutes away from the opening bow this morning. Good morning to you. Target is lower by almost 8%. Equity futures down 2. We're off by 1% on the S&P, down by 1.25% on the Nasdaq 100. That's the price action. Here are your morning calls. First up, Evercore upgrading ExxonMobil to outperform, highlighting the stock's compelling valuation and impressive earnings growth. Your second call from Jefferies, upgrading Peabody Energy to buy, expecting shares to outperform as China recovers and demand picks back up. And finally, Morgan Stanley cutting its Avis budget price target to 156, pointing to continuing recession risks and secular headwinds. That stock is down by about 3%. Coming up, BlackRock's Kate Moore says to remain defensive, with growth stocks starting to look just a little bit more attractive. That conversation up next, with futures down 1%. This is Bloomberg.
energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
If in doubt, blame Target. You did that 3 weeks ago. You can do it again this morning to a certain degree. Equity futures are down by 0.9% on the S&P. On the Nasdaq 100, down a little more than 1 full percentage point. Target is going to be a whole lot lower at the opening bell. Maybe just not as low as it was 3 weeks ago. Another cut to the profit outlook. Switch at the board. There's your opening bell in the bond market. We look a little something like this. Yields lower by 3 or 4 basis points on a 10-year. Still just about holding on to 3% on a 10-year. In the FX market, euro dollar 1-0 and all the sixes out of the ECB on Thursday for President Lagarde. New York crude WTI 118.22. We are negative 0.2% with a big call coming from Goldman to have a little look at 140 later in the third quarter. Big headline crossing the Bloomberg too. Let's get to Mike McKee for a report from the World Bank. Morning, Mike.
Morning, John. Well, speaking of cutting, the World Bank cutting its global growth forecast. This would be a man bites dog or dog bites man headline, except that it's more gloomy than we anticipated. 2.9% is their forecast now for global growth. There's no accepted definition of what a global recession is, but as they say, that's close enough for government work, 2.9%. And they give us a stark warning that stagflation is on its way, low growth and high inflation will be around for a couple of years. Talk more about all the details in just a few moments, John, but a gloomy outlook from the World Bank.
Hey, Mike, looking forward to it because we'll catch up with David Malpass, the World Bank president, in around about 10 or 15 minutes' time. Mike McKee, thank you. One stock to look at, it's Target. We're down about 7.4% in early trading. Let's get to Abby for more. Morning, Abby.
Good morning, John. Yes, we have Target plunging down more than 7%. Right now, the stock at its lowest level since September of 2020. And this, of course, after the company slashes its profit outlook and its operating margins for the second quarter. Once again, the second time in 3 weeks. It's like Groundhog's Day. So Target down about 7%, weighing on the other retailers. Walmart, Macy's, and Wayfair all down sharply too, as it's a fear that it could be not just a Target problem, that inventories are bloated at a number of retailers and as folks spend more money on experiences. And of course, relative to those operating margins, the company now looking for a 2% operating margin in the second quarter. That is the current quarter. The average analyst closer to 6.6%. Now, they do expect a little bit of a recovery later this year toward a 6% operating margin. They also expect the fiscal year revenue growth to stay in the low to mid single digit range. So a bit of a mixed picture here. It really seems like a true operating problem as opposed to customers so much. But it's pretty clear, John, that if they slash the operating margin to 2%. They have the ability to discount in a big way to make the items look attractive. The stock, as we were just looking at, also on sale, down sharply, down more than 30% since its fiscal first quarter was reported. The question is, when will investors want to buy? That'll come down to the E in the PE when it stops falling.
I should point out again and repeatedly, we did this 3 weeks ago. We're doing it again this morning. Gabby, thank you. About 2 or 3 minutes into the session, this is what we look like. The S&P down 1%, energy outperforming up 0.2%, information technology together with consumer discretionary underperforming, IT down about 1.2%. Taylor Riggs, some of these big tech names facing a familiar problem. Higher yields, and that's the story of the last week.
Indeed. So today, of course, that story reverses. We're back below 3% on the 10-year, but you're totally right in terms of the long-term trend has been the path to yields higher. Ian Leon over at BMO Capital Markets yesterday saying that look for more cheapening, especially when we're getting some supply this week as well, particularly on the long end. So with yields higher and some of the cheapening, a bond price lower, that certainly means more volatility within the tech space. That's what you're seeing there, Don. It was pretty incredible. We've gotten used to a lot of this volatility, but you've done now almost 3% swings from the peak of yesterday, big gains higher into some of the sort of losses today when we take a look at the NASDAQ 100. And the futures and sort of that intraday price action. If there is any good news out of this, it's sort of a re-evaluation of some of these valuations, how we're thinking about valuing these companies. As you can see there, we're actually sort of back to where we were pre-COVID. So sort of leading to a lot of people saying, have we taken a lot of the froth out of the market? Gina Martin-Adams out of BI, huge note this morning, fair value on the S&P looks at around 4,100 or so. When you think about really sort of the forward PE ratios of all of these companies, John, as you mentioned, though, when we think about froth and sort of pulling out of this market, $3 trillion year to date has been wiped out so far this year. Take a look at this, and it's all the big companies, Apple, Microsoft, Amazon, just really seeing a lot of that market cap coming out.
Absolutely brutal. Taylor, awesome as always. Look out for Taylor's coverage at the close a little bit later with Romain and Caroline Hyde as the market close wraps up. The open just underway, a couple of minutes in, call it 4. And no real drama on Twitter this morning. We're down just 1/3% to 39.44 as Elon Musk is threatening to walk away from his $44 billion deal. Back with us. Let's get to Ed for a little bit more. Morning, Ed.
Yeah, morning, Ed. A more modest decline, but still the spread widening, right, between $54.20 offer price and the current share price. Interesting reporting on the Bloomberg terminal from Kurt Wagner. There's no such thing as buyer's remorse. We always say on this program, we don't know what's inside the head of Elon Musk, but we do know what Twitter's board thinks. They've said in the last 24 hours they intend to hold Elon Musk to the terms of the agreement reached on April 25th, which is $54.20 a share, valuing Twitter at $44 billion. That's a phenomenal deal when you take into account the sell-off in tech stocks that we've seen this year, and you just discussed that with Taylor. Another piece of reporting on the Bloomberg terminal overnight, John, the Texas Attorney General has opened an investigation into Twitter, looking into whether they're misleading the public over the proportion of users on the platform that are bots. Interesting.
Ed, this is turning into a mess for both sides at the moment, that's for sure. Ed Ludlow, thank you, buddy. As always, that stock basically unchanged. Let's get to the broader, the bigger debate of the last couple of weeks. We've seen a squeeze in the stock market. We're off the lows. Is it a bear market rally or the start of a new bull phase? Strategists continuing to weigh in on the debate, with strategists running the following. One of the more difficult calls in this business is differentiating between a bounce in a downward trend versus the start of something more durable. Our best guess remains the rally is more the former than the latter. Let's get to Kelly for more. Hey, Kaylee.
Hey, John. Well, Chris Verone, who heads up technical analysis over there, is pointing to momentum as his reason why. He says typically when you see a significant market bottom, there's a lot more stocks trading above their 50-day moving average in the S&P 500. That usually that percentage number blows out to something in the realm of 80 to nearly 100%. We have not seen that yet. As of this moment, only about 41% of stocks in the S&P are actually trading above that technical level. So he says that raises doubts about whether this uptrend can actually last. Because yes, the S&P 500 has recovered some ground after narrowly avoiding falling into a bear market just a few weeks ago, but still the index is down more than 14% from its record high in the first couple of trading days of this year. And we know that there are plenty who think that this still has further to go. The loudest voice being Mike Wilson over at Morgan Stanley, who's warning about earnings, saying by the time we get through the second quarter earnings season, when we're in mid-August, this index could be down around 3,400. And Bank of America's Michael Hartnett also is in the camp that this is just a bear market rally, saying he would short the S&P above 4,400. Meanwhile, JP Morgan in the more bullish camp, saying the fundamental risk reward for equities is likely improving as we see peak Fed hawkishness and peak dollar strength. And overall, strategists are still leaning on the bullish side. The median year-end target for the S&P 500, 4,800, John, though it's worth noting there is a 35% spread between the lowest and highest targets. So that really just speaks to the division out there on the street right now, John.
Big time. Well illustrated. Kelly Lyons, thank you. Thank you very much. Here's the take from BlackRock. Here's the quote. Defensive positioning and capital preservation will dominate in the near term. A list of hurdles needs to be cleared before aggressively adding to risk, but mispriced companies are increasingly harder to ignore. Pleased to say that waiting patiently is Kate Moore of BlackRock. Kate, let's borrow that language from Strategas, that decision. Is it a bounce in a downtrend or the start of something more durable? Which one is it?
Yeah, I'm going to agree with Strategas, actually, John, and say it's pretty difficult to identify at this point. The one thing I'm really focused on, though, and this is where, like, figuring out exactly the direction over the next couple months becomes increasingly difficult, is that this lack of conviction across investors. We've had, as you mentioned just a moment ago, kind of weaker breadth. There seems to be across all of the investing segments, a lack of strong conviction in the direction of the market, going into September. Now, next year, I think people are going to be more optimistic, but we're not really fully pricing in 2023 at this point. So I think I'm not going to call it a buyer's strike, but I think we're going to see a lot more investors remain on the sidelines, remain cautiously positioned, and that actually may lead to some interesting opportunities for longer term investors.
Okay, let's talk about those opportunities. You've got three themes. I want to start with this one. It's timely. The consumer and the rotation from goods back to services. Is Target evidence of that happening right now?
Yeah, I mean, I think that's going to be a really interesting thing to watch, not just in Target, but across the entire competitive group there. I agree that everyone's extrapolating Target's experience to their peer group and then perhaps to the entire retail industry. The silver lining of this, and I know this has been discussed a little this morning, might be that goods prices actually see some disinflationary pressure as a result. And that would be, on balance, pretty good for the consumer. But as we've talked about a lot, we're seeing this rotation from goods consumption to experience and services spending. I think that is a very durable trend through the entire rest of 2022. And so maybe that's a little where I'm focused on the pricing side. I'm not worried about the health of the U.S. consumer. I think this rotation is clear and makes sense coming out of the pandemic. But we do want to be conscious of where the opportunities are from an earnings perspective. And if those retailers have bloated inventories and we're seeing this rotation in terms of spending, then I think we need to be thoughtful about where we're putting our money to work.
Okay, energy, another story for you as well. That's another favorable, durable trend you expect to persist because of what you say the supply-demand backdrop is going to support natural resources. The numbers out of Goldman, Kate, are unreal. 140, a 3-month price target on Brent. WTI at 137, and even 12 months out, they're looking at 130 and 125 respectively. Do I want to play that still through the energy names, even after they've ripped as much as they have, Kate, this year?
Yeah, look, we firmly believe there's still upside in energy and resources. Of course, it's going to be volatile. Of course, we're going to see some bounces. And of course, the bear debate here is whether or not slower global growth will take some of the demand pressure off resources. But it's been the supply side that really led us into this investment to begin with. In the fund, we had started adding exposure to energy and resources over the course of 2021. Of course, we continue to add through the beginning and part of this year. And now energy and materials are significant overweights for us. Look, we think even in a slower economic growth environment, the supply discipline, both from sort of industrial metals and miners, as well as on the energy side, really supports elevated prices for the medium term. And many of these companies are trading at really discount valuations to the rest of the market. And I think we can still get significant upside from here.
Okay, the last one in your three themes, this is the one where I really need some help. You say the secular trend of digital spending and transformation across industries. Now, typically when people hear that, they'll be thinking some of these tech names that did well in the pandemic and they're really struggling now. What do you mean by this? Can we get some more detail on where to look for that theme?
Yeah, when I talk to people about technology and I say, hey, I still see a huge amount of potential upside over the medium term, you know, sometimes people say, well, what about these big mega caps that really outperformed the market over the course of the pandemic? Isn't their story over? And I say there's a lot more to technology enablement, and to this digital transformation outside of the top 4 or 5 names. In fact, it's more around software and enterprise spend. We've talked a lot about security software over the last year or two. That I think we're going to see very durable investment across all industries. So I would tell investors to take a look below the mega caps and take a really strong look at where demand and spending will be. And I think they'll find that, you know, even though multiples have come down, the revenue and growth story, you know, remains intact. You know, these are places that most CFOs, most CTOs, and most, you know, management teams will not cut their spending. These are kind of durable and resilient areas, I think. And so I think we have some interesting valuations and good long-term durable growth.
Kate, a clinic, as always. Wonderful to catch up. Kate Moore there of BlackRock, breaking down the 3 themes she's looking at. This is what we're looking at right now. About 13 minutes into the session, the equity market down 0.6% off the lows. Speaking of off the lows, Target now down about 5%. Just as the session grows older, things get a little bit better for that name after the second cut to the profit outlook in just 3 weeks. Coming up, the world feeling the effects of rising inflation and slowing growth.
Economic dislocations, whether it's a recession or just depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people.
That conversation up next with the World Bank President, David Malpass.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Economic dislocations, whether it's a recession or just depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people. When you talk about the consumer, you got to ask who's got the wherewithal to withstand a slow patch in the economy.
The World Bank has a warning. Here it is. Here's the quote from their latest report. The world economy is again in danger, facing high inflation and slow growth at the same time. Even if a global recession is averted, the pain of stagflation could persist for several years. Mike McKee joins us right now. Hey, Mike.
Good morning, John. Well, it is stagflation in the forecast from the World Bank. That is low growth, high inflation. They say it could last for years. They predict that global growth will just reach 2.9% this year, which, if you ask any international economist, comes very close to the idea of a global recession. Now, take a look at what's happening in individual countries. Almost all of the developed nations have seen their growth forecasts cut in half by the World Bank. The U.S. goes down to 2.5% from 5.7% coming into the year. China, 4.3%. Interesting question for David Malpass. With COVID still hanging around there, can they even make 4.3%?
Yeah.
Euro area cut in half. And here's the sad part. We've talked a lot about the destruction that Vladimir Putin has brought to the world economy, not just his own. And we've talked a lot about Russia, down 8.9% this year. The Ukrainian economy now forecast to contract 45% because of Russia's invasion.
Mike McKee, that is utterly depressing. Mike, thank you. Let's speak to the man himself, David Malpass, the president of the World Bank. David, fantastic to catch up with you, sir. Let's start with this. Mike touched on it. How would you define a global economic recession, and is this it?
Hi, Jonathan and Mike. This is many countries will have a hard time avoiding a recession. We're not in. It's not a global recession yet. It could. The downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years. That's from the 2021 rate, which was high because of the recovery from COVID, to what we're looking at now, 2.9% in 2022. That's a very sharp slowdown, and it's really hitting the poorer countries hard.
David, what's interesting about this report is there is a temporary attitude to the conversation on Wall Street. I have them every day. You listen to some of them, I'm sure. When we have these conversations, we talk about maybe lasting 6 months. You go into 2023, things change. The essence of this, or the epicenter of it, is a dynamic that lasts for years. David, this stagflationary story could last for years. Is that really the case for you? And over what regions? Is this a global story or more concentrated for emerging markets and developing economies?
It's global, but it particularly hits the developing countries. There's a lot of inequality in the world. So the advanced economies, and particularly the people at the top in the advanced economies, have done very well over the last decade. So the reason that this is a prolonged risk for the world is that we're coming off of a very exceptionally low period of interest rates. Last year I called it uncharted territory on both fiscal policy, which was massively expansionary, and the monetary policy. So we're coming off of that. And you also have demographics, which are gradually slowing down in the world, fewer people coming into the labor force. And so that's part of it. And then this core problem of lack of supply and the supply chains not being repaired. One thing I'll add to this is energy is at the core of a lot of the supply. It's what makes fertilizer. It's what makes electricity. And there's as Russia is excluded from this, it means there's a big shortfall of energy, and it's not being made up for by new supply.
David, as you've pointed out and we've talked about, we're going to see a massive wealth transfer from the commodity importers to the commodity exporters. Within that, we're going to get some financial imbalances. Now, David, if I was doing this at the consumer level, if a consumer faced tough times, I'd be worried about a loan shark, if you will. Who is that loan shark on the international stage? And I know previously, in previous years, you've been worried about China and some of the loans they've made and the conditions around those loans that have been made to some of the economies that you focus on. Are you more worried about that now with this playing out?
China was the biggest lender during this expansion of the world, lending into countries, both poor and middle income countries. So one of the concerns right now is our data shows that it's 60% of the countries are either in debt distress now or at high risk of debt distress. That's for the 75 poorest countries, the IDA countries of the world. 60% are in debt distress, and with a big chunk of that debt owed to China. So we really need to find ways to restructure the debt and have it be more transparent. You know, the contracts have been written in recent years with collateral clauses, with non-disclosure clauses, and so the countries, it's hard to engage the conversation. So we've really worked with China to have them engage in the conversation to do the debt restructurings for the countries that need it. Right now, though, the distress is spreading to the middle-income countries. And I want to come back to the first point, Jonathan, that it's imperative that there be more supply in the world, especially of energy.
David, what's the likelihood of that happening anytime soon? Are these real suggestions that we can actually act on, or is it just a warning that this is what we're going to face now for a long time?
There are immense amounts of available, you know, natural gas is a key component of fertilizer and of electricity, cleaner energy for electricity generation, and it's available. It just needs to be announced, and the markets are forward-looking. So if you announced an intention to have more supply now, it would affect prices immediately, but we've seen that that's not happening. Oil prices are way up, I don't know, today, $119 a barrel, and so that's showing you that there haven't been announcements of supply, and I don't see that the governments are making steps on that. Canada did announce an ability to increase supply. I think Mexico and the U.S. could increase supply substantially, and Europe itself has energy reserves that they could be tapping, but so far it's not happening.
David, you took us to clean energy, so let's go there. The FT reported recently that the Treasury sent you a letter, sent the World Bank a letter, asking you to increase your efforts to fight climate change and provide what they called more forceful and constructive leadership. Can you confirm that you received that letter, and can you talk to me about the content of it?
Yes, there was a letter. It was sent in March, so I don't know. The FT is digging deep into its reserves. They mentioned a UN criticism that was done way back in 2021. You know, there's lots going on in the world that I think would be a better focus. The U.S. government has been strongly supportive of the World Bank and what we're doing here. That comes out at every meeting, and it shows in the support from the appropriations process of the U.S., the bipartisan nature of the support for the World Bank. The reason is because we're doing a lot on climate, and I wish the FT would ask what you're doing and what others are doing, and recognize the World Bank has a strong focus on actually reducing greenhouse gas emissions by countries and having impact through careful spending. There's been this big movement in the world just to spend more money and not worry about whether it's having any impact, and greenwashing. And we've worked to get away from that, and that's made some of the lobby. There's a big lobby for greenwashing, so they're not happy when you talk about impact. But we're going to keep doing it and keep making progress on cleaner energy. That means a lot more natural gas supply, and that's critical for future global growth because it holds down prices.
David, I'm trying to work out if you're more annoyed with the FT for publishing the piece or with the Treasury for sending the letter, but I haven't got time. David Malpass, great to catch up with you, sir. Thanks for joining us this morning. David Malpass there of the World Bank. Let's get to it in this equity market. Looking ahead to an ECB on Thursday, looking ahead to a CPI report on Friday, with an equity market looking a little something like this on the S&P 500. Equities lower by 0.4%. From New York City, this was the countdown to the open. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a